Let's start off with a slide on the US. Now, there's been a lot of noise about US recession over the last couple of weeks. Uh, Before that, you didn't really hear too much noise about US recession, but suddenly after the non-farm payroll numbers for the month of July came out, you started hearing a lot of noise around the US recession. Now, where is this coming from? So your non-farm payroll numbers that came out first week of this month of August, which pertains to the month of July, came in much lower than what the markets were expecting. So with a sudden drop in your non-farm payroll number additions, which is basically your job additions in the US, the market started getting concerned, saying, is there really going to be a recession in the US? Where is that coming from? It's coming from the fact that unemployment went up a bit in the month of July. Now, before concluding that a recession is coming in the US, you have to look at key indicators in the US and try and see how they behaved before in the previous US recession. So the last US recession that we actually saw, for all practical purposes, was the 2008-2009 recession, the global financial crisis that happened. Now, there are three key variables you have to look at. One is we're talking about the unemployment rate, which is what the markets reacted to. Then we'll talk about initial jobless claims, and we'll talk about the GDP numbers. Now, if you're looking at the unemployment rate, the unemployment rate has moved up, as you can see in this chart here, but has remained under 4% for a while now, and it is just normalizing to a higher level. When compared to 2007 to 2009 recession, where you can see the unemployment rate has been elevated above 5% for a fair bit of time. So currently unemployment rate is well below what we saw in the previous recession, and that does not really seem to indicate any sign of concern. Now, the second is initial jobless claims. Now, what are jobless claims? So initial jobless claims are fresh claims of joblessness in the US economy. If you look at where they were in the previous recession, you can see that the jobless claim numbers are north of somewhere around 330,000 a month, a week. If you compare it to now, the jobless claim numbers on a weekly basis are more just above the 210,000 mark or so. So you can see there's a fair bit of difference. So initial jobless claims are much lower than where they were in the previous recession. Now we'll come to the third and the most important part. Where is US GDP growth, US growth? US growth has been trending up over the last few quarters, and they are much higher than where they were in the previous recession. Now, one small bit that I forgot to mention is how do you read these charts? R-1 is 1 month before a US recession. We are talking about the recession in 2007 to 2009. R-4 is 4 months before a recession. R-7 is 7 months before a recession. Similarly, these weekly initial jobless claims, R-1 is 1 week before, 4 weeks before, 7 weeks before. And similarly, you read this as 1 quarter before, 2 quarters before, 4 quarters before, 5 quarters before. So like you can see, all the three key indicators we are looking at that talk about a probability of US recession, all of them are well below where they were in the previous 2008-2009 recession. So none of these indicators are telling us that a US recession is down the line. Now, we also remember here that all through 2022 and 2023 and in our dailies, we have been consistently talking about how the US is not going into a recession. A slowdown in the recession is quite likely that we will see in the quarters ahead, but a recession or a hard landing, as the markets call it, we don't really see that at all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.